Happy Sunday, ladies and gentlemen, Allincrypto here, and welcome back, guys, for what is going to be nothing short of another jam-packed daily cryptocurrency market update. We have a lot to get through, and in yesterday's video, we looked at what the kind of reaction and ramifications were or are of the sort of economic data that we had on Friday. We're going to be kicking things off there once more. We're going to be starting with some analysis from Goldman Sachs. One thing I think you can definitely derive from the markets right now is that it's a very interesting time to be speculating on them. And you're in that kind of heaven or hell camp that we spoke about in yesterday's video. Are we in the short to medium term, about to fall into a deep, dark recession, or does it come later on? And it's our belief that the recession comes later on, and that ultimately the markets are going to do well into that. So we're going to have a period of prosperity for the markets into what is going to be an SHIT storm. We'll be talking about all that in this video. We are also going to be looking at some really interesting things in regards to Warren Buffett. Now, Warren Buffett and Berkshire Hathaway over the last quarter has sold more stocks than it ever has in history. And we know that Berkshire Hathaway right now is holding a $276 trillion cash pile. Why is this? Where's that cash held? Is it in money market funds and things like this? Perhaps collecting a decent interest. And when we start to see interest rates fall, we know that there's currently, I think it's $6.7 trillion within money market funds. We're likely going to see cash flow back into the markets, in my opinion, to find that yield, providing that the environment is a right one. And kind of Warren Buffett, there's kind of a Warren Buffett versus Stan Druckenmiller sort of saga going on here in regards to Stan Druckenmiller betting on the IWM, which is a very interest rate economic related, or let me try and rephrase that, economic data dependent sort of basket of stocks, if you will, smaller cap stocks, that ultimately he's only going to be betting on if he thinks it's going to be a good environment for risk generally, whereas Warren Buffett is obviously very cash heavy. We'll be talking about that. Then looking at Bitcoin. Lots of people very concerned about the altcoin market. It's brutal. This is altcoins. This is the nature of the beast. If you look at how the altcoin market typically reacts to pullbacks and sell-offs, it's doing much of a similar thing to what we've seen previously, and we still believe, based on everything that we've looked at, that it is going to result to the upside. And we're going to be showing you that this is very much a pullback for altcoins led by Bitcoin. Of course, we know Bitcoin is still the tide that rises and sinks all ships, and that there's not really anything out of the ordinary or, in my opinion, cause for concern. It's our opinion that Bitcoin is just in a pullback, a corrective phase, and we're ultimately still going to get to that $151,000 target, and the market is going to go with it, and we're going to see altcoins really perform, certainly in regards to where Bitcoin dominance is and the kind of, I think, important to watch state that it's in regards to we think it's not that far off rolling, and ultimately that's going to see an alt season do very well. We can drive that from a number of things, whether that's ETH BTC, whether that's the Bitcoin dominance chart, ETH dominance, Sol BTC, or a number of other things. Then we'll be preparing you for the week ahead. So we have a hell of a lot to get into, guys. Without further ado, let's dive into it all. And let's start things off with sort of recapping on Friday's event. So Friday we had non-farm payroll, and we also had the unemployment number, which is probably the more important of the two in my opinion. So Goldman Sachs reports USA payroll growth slows by more than expected. Unemployment rate rises to 4.3%, changing our Fed forecast to 3 consecutive base points. So it's very interesting. Really this year, and we were one of the few people to highlight this, we've had this kind of readjusting going into this year in regards to how zealous the Fed were going to be in regards to cutting rates. Now, they haven't cut rates as quick as one would expect, or was certainly expected going into 2024. And you can see this is the kind of readjustment that we've seen. So January, obviously starting down here, 2024, you can see just how zealous this had rates coming down. And we're now at this kind of red point. And we're ultimately looking for, this is August, the recent report, rates coming down at a faster pace than we've previously seen, but rates have been higher for longer. Now, we were one of the few people to look at the fact that rates going sideways has historically been a good thing for the markets. Okay, in certain circumstances, if you look at the last 5 times they lowered rates, that's 4, 5, get it right, all in. 2 times a crash has been imminent. The other 3 times the market then rallied, and whether it's 2020, which led into the March 2020 events, the market then crashed later. And this is the camp I'm in. I think we're going to get this rally into what potentially could be a global reset. If you look around the world right now, a bit of a side topic, there's a lot of unrest taking place. It's my opinion that this is all deliberate and designed. They caused the problem. They use the reaction to the problem that they've caused to implement their solution in regards to bringing us all under one banner, and ultimately calls for measures. I don't want to go too far down that rabbit hole, but to stick at the topic at hand, which is where we are in regards to the markets, we're now getting another readjustment in regards to on the back end of non-farm payroll. If you listen to Jerome Powell's speech, and of course unemployment data, he didn't really give away too much, but one thing he did say was if unemployment starts to uptick, we'll be willing to react. And I think if you look at historic Fed easing cycles from a rate point of view, they don't do it in a very paced manner. They often come down very quickly. You can get that historically from looking at the Fed fund rate. So it seems like in September, it's very much a given that we're going to get that rate cut. And actually, we might get something a little bit more than that rate cut. We might look at 225 basis points or a 50 basis point cut coming in, which would align with sort of Goldman Sachs changing their tune. Now, double-edged sword here is typically rates coming down, which is going to bring the dollar down, is a very good thing for markets. Certainly risk markets, we've looked at this, we've done lots of work on it. That certainly aligns with what we've looked at technically in regards to the crypto space. But rates coming down as a result of a 2008 or a dot-com crash, that's not good for markets. And that is something that we need to avoid. And one of the things to know that we're going to avoid that is watching the likes of the unemployment stats. The correlation between unemployment and the stock market is when unemployment's at a low, stock market is at a high. This is historically true, except for down here, by the way, guys. So we've had a bit of a... This is the interesting thing with where we are currently right now. It's a very tricky environment because there's a lot of kind of double-edged swords and anomalies going on at the moment. And we're, honestly, I think we've got generally the markets exceptionally right. If you look at the calls we made for the stock market, if you look at the call we made for rates, if you look at the call we made for the Dixie, for inflation, even for altcoins, when you consider the fact that we only really got it back into the market here, guys. And yes, for some altcoins, it's been a lot more sideways than this, but generally we've got the direction of the space right, and we think it's going to continue. And we think you're going to avoid this sort of SHIT storm. So that historic correlation, this is interesting, has been when unemployment's at a low, markets at a high. Unemployment at a high, markets at a low. Except for here. Unemployment was at a low, but the markets were at a high. Now that's very interesting, isn't it? It's kind of similar to where we were just before we had that major rally into... or perhaps ignore what I said there, guys. So there's a bit of an anomaly going on here. Because this kind of hasn't been followed, but generally you should bear in mind the fact that unemployment upticking means there's economy isn't doing as well, which means that the markets aren't going to be doing as well. Even though that hasn't been followed recently, it's still something to pay attention to, and it's something to watch. Are the Fed, you're in two camps right now. The Fed are going to cut rates, it's going to happen in an orderly fashion, and we're going to avoid a recession. And I think other economic data is perhaps signaling that. Or the Fed are going to cut rates. It's too late. They've held them high for too long, and then we enter this absolute SHIT storm. In the short term, it's got to be in the short term. The S&P will rally 2 months up until a recession. So it only starts pricing a recession 2 months prior to it, historically. So you're in the short term, we're heading into a recession, or the recession comes later and the market's actually going to rally into that. That's the camp we're in, and we think technically we have merit to suggest that. Whether that be looking at historic rate easing cycles, whether that be looking at technically what we're looking at for the cryptocurrency space, technically we're looking at for the stock market, gold, and then comparing that with crypto, we think crypto is going to be the fastest horse in the race, whether that be what we're looking at in the bond market, the yield market, the forex market. We don't think the SHIT storm comes in the short term. We think actually it's likely going to play out next year, and the markets are going to do well into that. And right now you're just having this kind of shock of, this is bad data that we need to pay attention to. Let's talk a little bit about Warren Buffett, who you can only but give credit to. The one thing I will say about Warren Buffett is his trade, the trade of his life, has basically been betting on the proliferation of the monetary systems. And there's that beautiful picture of him laughing with all the bankers. I think you've got Greenspan in there, you've got a number of others, and he's kind of laughing with them. And I think that very much sums up his sensational investment career. Is he's just understood that it's a kind of short, the Japanese Nikkei is a short yen trade, just like the S&P is really a short dollar trade at this point. This is why people always say to me, well, look at this company, everything, the stock market's overvalued because this in regards to earnings. Well, people aren't taking into account the proliferation of the money supply. But To not confuse people, Berkshire Hathaway net purchases or sales of equity securities. Berkshire Hathaway has dumped more shares this quarter than any other quarter in its entire history. They know what's coming. And I think something big is coming. I think the mother potentially of all crashes is coming. The question is when. So you could end up like a kind of Robert Kiyosaki or a Dan Pena that has been calling for a crash now for 20, 30 years. And the market's done that in the face of it. Robert Kiyosaki, in all credit to him, is a big gold guy. And, you know, gold's done well in that, generally in that proliferation environment. Somebody like Dan Pena, for example, that just holds cash, you've actually lost massively purchasing power waiting for something that, you know, is coming a lot later than perhaps you thought it would. And this is where we like to be in the market. We like to be in a bit more of a sweet spot. Just to give a little bit of pushback in regards to, okay, somebody like this selling is significant. Why might Berkshire be holding $276 billion worth of cash? Well, it probably has a lot to do with the interest rate they're getting on this. This is money market funds are at a record high, $6.4 trillion. When they start to lower interest rates, which you know they're going to do, that money's going to go elsewhere for yield. That could be something that really fuels the stock market and is worth paying attention to. And that could be why Buffett's as cash heavy as he is. Although it's not an amazing sign. There's no way of me sort of spinning that to fit my narrative. However, you've got this kind of Stan Druckenmiller or Warren Buffett, Stan Druckenmiller fight going on at the moment in regards to Stan Druckenmiller moving into the IWM, which we'll take a look at because it recently had its breakout. So he's betting on small cap stocks that do well in a good economic environment. And we saw the big move that we were expecting. It's coming back now, but is this just a sort of retest before we see that continuation, a kind of stop-start? I think it is. He's obviously betting on a small cap basket stock that does well in an environment where certainly we aren't in a recession. Interest rates are low or starting to come down, very interest rate sensitive. And there's economic sort of okayness generally, or certainly a good time for risk. Whereas somebody like Warren Buffett now saying, okay, we sold Apple. Let's bring Apple up. Why is he doing that? Apple's one that we haven't really been that good on. Just to sort of highlight to people again, you'll remember that we were actually calling for, when we're still calling for $261 Tesla. Sorry, not Tesla, Amazon. We're also calling for a $500 plus Tesla. That was at this point here when Jeff Bezos was sort of selling all his stock, and we were saying, okay, well, technically we're going to go with the other side of this. And I think there's these people I think will eventually be right, just not yet. Tesla's another one that we're looking at. There was a gap that we were looking to get closed before we really started getting aggressive in regards to this. That's been closed. There is a CME gap on Bitcoin that I do believe is going to get closed. So the price of Bitcoin today is 60,900. So that's, yeah. So this gap actually might get closed. If we look at Bitcoin, it did actually get down to that closing gap point, but it needs to open there on the CME, and then there's that gap closed. And ultimately, we do think Bitcoin's this is a pullback in what is a broader uptrend, and unfortunately, altcoins are just along for the ride, I'm afraid, ladies and gentlemen. The crypto market generally is along for the ride. When I look at institutional inflows into the crypto space, they've really picked the winners thus far. Bitcoin, Ethereum, Solana. Solana had more institutional inflows than Ethereum up until 2 weeks ago. Explains why it's done so well. And when you look at the altcoin market, there's no interest from retail. We spoke about our insight as a channel here. We get some of the most viewed content in regards to Hedera Hashgraph, ICP, XRP recently. Big thank you to the XRP community out there. Things like Polkadot, Cardano. If you type these in on YouTube, will come up. In fact, we've got some of the most viewed videos out there on these subject matters. A good video for us on these topics, other than XRP, which does a lot better, is between 10 to 20,000. YouTube has 6.1 billion users. Nobody's interested in altcoins right now, and institutions not buying them. So it's this kind of floundering market. I know Raul, I had a bit of an interaction with Raul on Twitter, Raul Pal. He was looking at jump trading, potentially liquidating some crypto. Events like this aren't going to see the crypto market do well at a time when nobody's that interested. But back to the topic at hand, our general belief is that we're still going to 151k for Bitcoin. This is just a pullback, and we've got Bitcoin, and then we've got some of our favorite altcoins like Hedera, Link, and ICP. You can see what we're looking at here. They're just following, but obviously significantly weaker as a result. And when you look at their charts, because they haven't had that institutional involvement, to pick on Link as an example, it's a lot more it's a lot more kind of pronounced, but there is, I think, some structure that could set up for a breakout across most of these coins. So we still do think this is just a pullback in what is a broader uptrend. Yes, there's a lot going on the kind of macroeconomic scale, but we don't think it's what we think the market's doing right now is acting like the market's doing, being a drama queen. We don't think it's that cause for concern just yet until we see real significant reason to think so. It's not a great sign, unemployment, and what we're seeing. There has been a bit of an anomaly here thus far, which I think is interesting to sort of note. But they are going to bring rates down. There's still this great sort of reasoning that you're going to see money flow back into the markets because it's going to hunt for yield. And actually, this could be why the likes of Warren Buffett has the amount of cash that he has, because he's ultimately collecting a great return on it. To finish things up, I think I've covered predominantly what I want to finish. Let's take a quick look at the week ahead. It's a lot easier this week than it was last week. Last week we had 20% of the S&P's earnings out. We also had all the economic data that we had, and we did say expect volatility. We've seen that volatility. Okay, what happens this week I think is going to be very important. We've got US ISM, so PMIs. We've got Bank of Australia rate decision. They're expected to hold rates. Very interesting. UK construction, Canadian IV, US crude oil inventories, US initial jobless claims, so on and so forth. So this is going to be very interesting to watch, but not as significant as what we had last week. Dollar's very much coming in the direction that we wanted to. We're seeing targets, or certainly progression in regards to the Great British Pound against the dollar, and the euro against the dollar. Yen doing quite well against the dollar. You know, dollar rolling is very much what we're predicting. We think that's triggered. We also think the likes of oil doesn't look too hot. The question is does oil not look too hot because we're in a recession? And this is the hard part that I've got to try and answer. And I still am on the bias and thinking that we're not entering a recession in the short term, and that actually we're going to do just fine. A shitstorm is coming, but not until later on down the line. And we think we've got the sort of technicals and economics to back that up. That's it from me, ladies and gentlemen. I'm looking forward to hearing your thoughts in the comment section. And on that note, I'm going to love and leave you. Thanks a lot for watching, guys. I'll see you all in the next.